I have reviewed over 200 international tax structures, and there are 3 mistakes that show up in almost every case, and each one costs you tens of thousands in extra taxes. In fact, a client of mine is a Canadian founder who paid 30 grand for what he thought was a bulletproof global setup. It collapsed after one tax authority interaction, landing him with frozen bank accounts, back taxes, and penalties. So in this video, I'm going to show you what the 3 mistakes that got him charged for tax evasion are, the reasons that his offshore companies were pierced by authorities, and how to make sure that this doesn't happen to you. And if you're thinking, I'm not Canadian, this doesn't apply to me, think again. The UK, EU, and most Western countries have identical rules. So John, a Canadian founder with a 7-figure business, paid 30 grand to a Canadian tax lawyer for an international structure. On paper, it looked legit. A Canadian family trust sitting at the top, owning a US corporation which owned a US LLC, and the trust had 4 trustees, all documented, all signed off. But here's the problem. All 4 trustees were family members, and in practice, one person was making every decision. No independent oversight, no protector, no separation between who owned the trust and who controlled it. It was less of a trust and more of like a family group chat. When the CRA, the tax authorities, looked at this, they didn't see a trust. They saw John. They saw one guy pulling all the strings, with family members rubber stamping whatever he wanted. And the moment he realized this, he said something I'll never forget. Oh, so they think that I own all of this? Yes, that's exactly what they think. And that's exactly how they're going to tax it. Here's what most tax authorities apply. It's called the de facto control test. It doesn't matter what your trust documents say. It doesn't matter how many trustees you list. What matters is who actually makes the decisions. If one person or one family unit controls the trustees, the assets, and the decision, the tax authorities deem the trust controlled. And when a trust is deemed controlled by a resident of that country, it is treated as if that person owns everything directly. That means the trust collapses for tax purposes. All income flows back to you personally. You're taxed at full personal tax rates. And in serious cases, penalties, interest, and even criminal referral if it looks intentional. A real trust needs real independence. Independent trustees who don't answer to you. A protector with actual authority, documented arm's length decisions, governance that can survive scrutiny. Without that, you don't have a trust. You have a piece of paper that the tax authorities will ignore. So here's mistake number 1, treating a trust like a family group chat. If the same people who benefit from the trust also control it, it's not a trust. It's just you with extra paperwork. But this was just the first layer. The next mistake was hiding underneath. And it's the one thing that actually triggered the tax authority's attention. By the way, if this is sounding familiar, there's a link in the description to book a complimentary structure review with my team. We'll tell you exactly where your setup stands and opportunities to improve it. But keep watching. The second mistake is the one that actually triggered the tax authorities. So John had a US corporation sitting in the middle of his structure. On paper, it was supposed to be the operational hub, receiving income, managing assets, doing business. In reality, it had no office. No employees, no board meetings, no minutes, no independent directors, just a registered agent and a PDF. The entire corporation only existed on paper. And here's where it gets painful. John was actually filing US taxes on this entity. So paying US accountants, doing everything by the book in the US. But when we explained that the CRA considered his US corporation to be a Canadian company, he was stunned. He had paid US taxes completely unnecessarily on an entity that Canada didn't even recognize as foreign. This comes down to something called the mind and management test. Where is a company actually resident? Not where it is registered, not where it has a mailing address. It's where the real decisions are made. If your US corporation's board meetings happen on Zoom from your kitchen in Toronto, if every strategic decision is made by someone sitting in Canada, if there's no actual presence, no real operations, no substance in the US, then the CRA or other tax authorities say, this is not a US company. This is a Canadian company pretending to be American. And once they make that determination, your foreign income becomes domestic income, fully taxable in Canada. Plus, now you have a second problem. You've been filing in the US incorrectly, which means the American IRS might come knocking too. That is dual exposure. Two tax authorities both looking at the same structure from different angles. Real foreign substance means real office presence, independent local directors, board meetings that happen in that jurisdiction, decisions documented and made outside of Canada, actual operations, not just a registered agent. So mistake number 2 is building a foreign company with no foreign substance. If your international structure is just paperwork filed from your laptop in Canada, it's not international. It's domestic with extra steps. Now, these first 2 mistakes set the stage, but the third one is what actually put John on the tax authority's radar before he even knew that he was being watched. So here is where it all came crashing down. John had set up a loan from his US entity back to his Canadian company. On paper, it looked like a legitimate cross-border lending arrangement. Foreign entity loans money to Canadian business. Should be clean, right? But remember, John controlled the trust. John controlled the US Corp. John controlled the LLC. And John controlled the Canadian company receiving the money. So when the tax authorities looked at this loan, they didn't see a foreign lending arrangement. They saw John giving money to John. And that is exactly how they taxed it. Not as a loan, as income. And here is the thing that really got him. When he came to us, he genuinely believed, I guess all foreign loans are taxable in Canada. Nope, they're not. Only foreign loans done through fake structures get taxed like this. He wasn't confused about Canadian tax law. He was already being flagged and didn't know why. The tax authorities could see that the loan was coming from entities he controlled. They knew from day one that this was cross-border ownership with no real separation. And that's what put him on the radar. You could hear it sink when he finally realized he was being targeted because his entities weren't foreign at all. This is where cross-border loan rules come in. If you are borrowing from a foreign entity, the CRA or tax authorities will ask a simple question. Is this a real loan from a real independent foreign lender? Or is it just you moving money around between entities that you control? If the answer is the latter, the loan gets reclassified as income, taxable immediately, plus interest, plus penalties. For a loan to be respected as a loan, you need a few key things. You need arm's length terms, so real interest rate, real repayment schedule. You need independent governance, so the lender makes independent decisions. You need economic justification, so there's a real business reason for the loan. And you need genuine separation. You can't control both sides. Without those, it's not a loan. It's distribution dressed up as debt. And tax authorities will all treat it this way. So mistake number 3 is thinking that a loan is a loan just because you call it one. If you control both sides of the transaction, it's not a loan. It's you moving money between your own pockets. And tax authorities see right through it. So those are the 3 mistakes that collapsed John's 30 grand bulletproof structure. 1, a family trust with no real independence. 2, a US corporation with no real substance. 3, a foreign loan with no real separation. Each one on its own is a problem. Together, they are guaranteed to get flagged. Now, here's what we did to fix it. I'm not going to go deep into the technical rebuild here. That's for a conversation for a structural review. But I want to give you the headlines of what we actually did to fix this. First, we installed real no-control architecture, independent trustees, real fiduciaries, documented arm's length decisions with no obvious family control. Second, we created real jurisdictional separation, separate management, separate control, actual substance in the correct places, entities that function and look foreign, because they actually are. Third, we rebuilt the lending properly, arm's length, defensible, supported by genuine governance, not reclassified as income. The result? A compliant, multi-jurisdictional structure that the tax authorities can look at and say, yep, this is real, this is legitimate, this is a genuine international business. Not, this is just you with extra paperwork. The outcome? Far less tax, much more asset protection. If you're watching this and realizing that your structure might have some of the same problems, or you're not sure if it does, then you can book a complimentary structure review with my team. We'll look at what you've got, identify where the risks are, and show you what a compliant version of your structure would actually look like. There's a link in description. But if you would like to go deeper first, I have made a video breaking down the 4 signs that your tax structure has crossed the line from tax planning into tax evasion. Most people have no idea that they're on the wrong side of this line until it's too late. That's where I'll walk you through exactly what the tax authorities look for, how to check if your structure has any of those red flags, and what to do if it does. Click the link on screen to watch that next. And remember, stay sovereign.